The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon, everybody. Thank you so much for joining us today for our quarterly webinar series titled CIO's Corner, Quarterly Update with our Chief Investment Officer, Chris Gauthier. For those of you joining us for the first time, my name is Amanda Sylvia, and I am the Client Service Associate for Stonehearth Capital Management. I have been with Stonehearth for 3.5 years now, and my primary role includes client service, marketing, and compliance. I am happy to assist Chris this year with his quarterly update webinars. I would like to start off with just a few housekeeping items. On your GoToMeeting taskbar, you should see a section titled Questions. Please feel free to submit your questions throughout the course of the webinar. I will be monitoring them, and we'll ask Chris to answer as many as he can at the end of the webinar. If we do run low on time and are unable to get to your question, Chris or myself will reach out to you directly to make sure we can get your question answered. Now, I would like to introduce our speaker for today. Chris Gauthier is Stonehearth's Chief Investment Officer. He brings more than 15 years of investment management experience to our firm, working with both institutional and individual investors. He is responsible for setting the firm's overall investment policy and strategy, including directing our asset allocation, investment risk, research, and portfolio management functions. Chris, thank you so much for speaking with us today.
Thank you, Amanda, and welcome everybody. Have a good afternoon. Thank you for that wonderful introduction, Amanda. Well, to jump right in, it's certainly been a very interesting start to the fourth quarter in the financial markets, to say the least, with the return of volatility. We have a lot to cover today, so we're going to jump right in. And as always, we're going to see if we can find the signal through the noise. So what we're going to cover today. So as always, we're going to start off with asset class performance, kind of what went on in the marketplace over the past quarter. Take a little bit longer view after that and take a look at what happened over the past year, and then take a look at the current investment environment, what it may be telling us about what's most likely to lie ahead. We're going to change it up a little bit this quarter. Given the recent volatility, I've added a few slides to talk about it. We usually take a much longer term view. Most of the data we're going to be seeing in the presentation is as of quarter end, because that's how the structure of the quarterly update is set up. But I think I'd be remiss in not at least addressing the recent volatility we see in the market. So we're going to take a few charts to take a look at that and see what that could be telling us. Then close it out by looking at portfolio positioning and what we expect for asset classes going forward. So before we get into all that, let's take a look at what happened in Q3 2018. What we're looking at here is a list of major asset classes in the market represented by ETFs. That at the end of the slide, you can see all the ETFs that these represent. And the first thing that jumps out is these blue lines. So all the US equity asset classes are highlighted with these blue lines. And you can see that the US equity has led the way. In particular, these momentum stocks, large cap stocks, returning over 9% and 7% in the past quarter, ending September 30th, 2018. So remember, as you're looking at all these charts, you have to take a step back and say this does not include the recent volatility we've seen in October. This is as of September. But at least for September quarter, the US has led the market. We also saw oil slow down its hyperbolic rise, as we'll see in the year chart, that it only returned 3%. But that is a big change from what we've seen over the past year. We're also seeing represented by the purple lines here is fixed income. We've seen there's really no return in fixed income unless you move far out the risk spectrum to take on credit risk. And that's represented by junk bonds right here, called 2.47, or high yield bonds if you prefer. Corporate credit, which has gained about 1%. But when you start going into the government bonds and other parts of the market, you see international bonds had no return. The muni bonds had no return, and long-term treasuries were really weak in September 2018. So in terms of generate any type of return in fixed income, you had to move out that credit spectrum and really take on a lot of credit and corporate risk. And once you get out to that edge of the spectrum, it really starts trading more like an equity than a fixed income. We also saw managed futures have a nice bounce back in September 2018. It's represented right here, 2.76. As anything highlighted in yellow is what we would consider alternatives. So you have the dollar, oil, posting positive returns, but managed futures did have a nice bounce back. And at least before the recent sell-off, international was trying to make a comeback. You see here by this 1% return, it returned in September in the third quarter 2018. And these are represented by international developed stocks. Emerging markets, frontier markets, still weak, but a little bit better than the quarter before. And while these did not keep up with the US, at least the international markets did post a positive third quarter in ending September 2018. So now we're going to take a step back even further and take a much longer time period and take a look at what's transpired over the past year. Now, you heard me mention oil that slowed its rise, and it's kind of tough to reconcile when it actually gained 2%. But you can see over the past year, it's up almost 50%. So again, really when you look at the past year's performance, it really is oil, then everything else. Its closest competitor, the S&P 500, only gained 17%. Seems weird to say only 17, but when you have an asset class that is such an outlier as oil, it's amazing to me that oil is still rising by 48%. But we expected volatility in oil. It's going to go up and down with no really long-term trend. It's just reacting to global developments across the world. We also point out here the dollar. So as you see, the dollar right here gained almost 5% during the past year. So we're seeing a lot of dollar strength. Again, no surprise there. The Fed's raising interest rates. They've telegraphed they're going to raise it further. We've seen some global turmoil, pushes people going into U.S. financial assets with the good performance we're seeing in U.S. equity. Supply and demand says if I want more of an asset, I have to buy U.S. assets. I have to buy dollars, which increases the price performance of dollars. The flip side of that is that also tends to hurt international performance. And you're seeing that with international developed markets only up 3% and emerging down 3%, and frontier almost 6%. So as the dollar weakens, when performance in international markets gets translated back to the US, and most of us are US investors, that impacts performance and shows it's a little bit more weaker. So in other words, if you're looking at the country of France, it was actually maybe gained 4% last year in its local market. Once you translate that back to the US with that strong dollar, you end up with a much lower return. And then we look at fixed income land, still not, even over the past year, not a lot of return to have. Corporate bonds are actually negative, almost down 2%. Long-term treasuries down 4%. And speaking of this fixed income, we're going to go into a little bit more detail about its performance, because I think it's going to come as a surprise to a lot of people that see negative performance in bond markets. And to give you a little bit of a preview and a hint of what's to come, this is not your parents' bond market anymore. It is much different. We're in a much different environment, and we'll go through some data points to kind of show why we think that is. So I started out by saying that we usually take a much longer term view, look at the current environment, but we're going to change that up this quarter a little bit and look at the recent volatility and see what this price performance is actually telling us. So what we're looking at here is the ETF ACQUI. So ACQUI represents all global equity markets. The US is part of that. The US is about 55% of this performance. So you can think that this performance includes all the US markets, all the European markets, EM markets, frontier markets, and the performance. We're looking at a chart beginning in the 2017 all the way up until October 25th, I should say, the close of the October 25th. So if we look at the green lines right here, this last one that I'm pointing to, you can see that from its recent peak, which was just only in September, it's falling about 9.9%. A fall never feels good. You know, it's hovering around this 10%. And even if we go back a little bit further and look at the peak this year, which happened back in February, it's still down only about 12%. And again, when you look at this, you have to put it in perspective. You think about what level we're at right now, and that's represented by this green line right here. We're right around this, a little bit above $67, $68. We haven't seen prices like this since just last year we're at this levels. So even though we're kind of impacted by all these volatility, all the noise we see in the marketplace, we really haven't retraced a big chunk of the gains we saw back in 2017. And speaking of 2017, I think what happened in 2017 and the impact investors had by looking at these performance will give us a little bit of insight into what's going on this year. And that's represented by these blue lines right here. So these are all the drawdowns we had experienced in 2017. So in March, we had a 2.3, April, we had a 2% drawdown, and during the summer, we had a 1.3, in the height of the summer, we had almost a 3% drawdown. In November, the last really big drawdown we had in 2017 was just 2%. So again, when we look at 2017 compared to 2018, we can see a big difference in terms of the volatility. And what we have to really take a look at is, which one is the outlier? Is 2017 the outlier? and that it's weird to only have small drawdowns throughout the year, or is 2018 the outlier and it's kind of looking at something much different and with much larger volatility? When we look at this, we think 2018 is more indicative of what we should expect with equity price action, and 2017 is really the outlier. Well, why do we think this is? Well, the long-term historical data tells us so. And it's good to remember, like, to look at this from a behavioral aspect. And why is 2017 having such a big impact on what investors feel about 2018? It's because our brains are wired to overemphasize recent events when we start analyzing. So our brains are wired to take what's happened in the recent term and put more weight on it than what's happened in historical. It's just how our brains are wired. Psychologists even have a name for it. It's called the recency bias. And we use this data to try to find the signal through the noise. So by looking at the data, trying to overcome these behavioral biases, we can take a much longer look and see what's actually happening. So let's take a look at this 12% drawdown that we've experienced in 2018 so far through the lens of history. And what we're looking at here is the S&P 500. It's not the ACQUI, but we have more data and longer data on the S&P 500. So I think it's equivalent to the ACQUI benchmark going back to 1980. And what we're looking here is you see the shaded lines. That's actual annual calendar year returns. So you can look at this. In 2017, we gained 19%. Now you go back, we lost 23, go back to the 90s, we're gaining 30, 20%. These numbers in red are drawdowns temporarily that we experienced during the year. So putting all this together, what does that say? That on average, since 1980, we've experienced intra-year drops, not permanent loss of capital, intra-year volatility of almost 14% drawdowns. And even with that 14% drawdowns on average, you've returned a positive return 29 out of 38 years. So what does this tell us about what's going on in the marketplace now? What it really tells us is that this is more normal. We should expect heightened volatility. We generate a higher return from riskier assets, which are equity assets, so we have to get compensated for that higher volatility. And 2017 was really the outlier. Most of it had to do with the cost of capital and just markets. But again, we really think 2018 is more normal and what we should expect going forward. And I kind of think about this and look back and, while it's true that all bear markets had a 12% decline to start, not all 12% declines have led to bear markets. In fact, going back even further and looking at the historical data since 1928, so before the Depression, roughly 60% of the time, that's over half, once we've had a 12% drawdown, it did not turn into a bear market. The market turned around and bounced back. So again, that's what we mean when we say we're trying to find the signal through the noise. What is this price action telling us? What's the market telling us? Is this something different? Is this a foregone conclusion that we need to go further down? And history tells us it's not. We could bounce back. We could also go down further. And that's why we look at multiple lenses, look at it through the economic, the technical, the valuation picture, and our qualitative judgment to find the signal to the noise. So let's take a look. I told you a little bit about the fixed income market. Let's take a look at what the fixed income market has done on a year-to-date basis. So these are those major asset classes in fixed income broken out. What we're looking at chart here is from Eaton Vance, and these are the averages, the yields, and prices. And if anybody has a question, we can go into them. But what I really want to focus on is these total returns. So these total returns on a year-to-date basis, the total bond market in the U.S., the aggregate U.S. return is a negative 1.6%. Again, I'll repeat that, negative. We look at mortgage-backed securities, think the mortgages that everybody holds, down 1%. We look at corporate, down 2%. Muni markets, down almost 1.5%. So then we move out into the international, EM bond index, they're down 3%. Corporate EM bond market down 1%. Government bond, 8%. So you're starting to get the picture here where there's a lot of negative returns in the fixed income market. We do see some outliers. Again, we saw high yield, which was slightly positive for the year-to-date basis, and leveraged loans, which we hold a large chunk of in your portfolios, returned 4.03% year-to-date. And we think they can continue to do that given the interest rate environment. Leveraged loans have a unique characteristics that their rate resets every 3 months. So as the Fed keeps raising rates, they get to increase their coupon payment. And we think that's a good asset class in an environment where the Fed is going to keep rates. And there's not a lot of positive return to be had in fixed income. I think this is going to be a big change to investors. You know, if you think about it, it's not often that you open up a statement and see negative bond returns. And I think this will come to a shock to a lot of people and will affect their decision-making process going forward. So that kind of sums up what's happened over the past quarter and the past year. And now we're going to transition to the current environment. And again, trying to find the signal through the noise. And as always here at Stonehearth, we take a weight of the evidence approach and look at the situation through multiple lenses. We're going to focus on what I call the big three today because they have such a large impact across all financial markets. And they are interest rates, inflation, and growth. And looking at it from those three lenses, we'll see what the current environment tells us about the future. So taking a look at interest rates first, what we're looking at here is interest rates, which are set by central banks, and not just the US. Sometimes we get too US focused here living in the US, but there's other central banks around the world. And we show 4 of them on this slide. We have the Federal Reserve here in green. So these are interest rates going back to 1997. BOE, which is the Bank of England. BOJ, the Bank of Japan. ECB, which is the European Central Bank. And looking at all these 4 banks, you can see that rates have been pretty low compared to history. And we can see coming out of the crisis, everybody really lowered the interest rates, which in turn, to simplify what's happening, is throwing liquidity at the market. It's throwing cash, in essence. Not real cash, but increasing liquidity so investors, so consumers will borrow and spend more and go out on the risk spectrum investing in assets. That's what they're trying to attempt to do. So the big picture takeaway from this chart here is that the US is much higher than everybody else. Again, leads to that stronger dollar that we saw over the past year. They have a much higher rate, they're at 2%. Everybody else is much lower. But trying to find a signal through the noise, what this also may mean to future price action is that they're going to remain lower for a lot longer than the US. So there's a longer runway for international equities given where they are in the interest rate hiking cycle. The US is way ahead of the curve in terms of everybody else. So that increased liquidity, which helps risk assets when they have lower interest rates, may help international and EM more than it helps the US. Switching to expectations, because they do really matter in here. Markets can handle what they know is going to happen. So if interest rates go up by a quarter point, they go up by a quarter point, they're all right with that. As long as what they expect to happen, happens. And I think the market may be underestimating the tightening cycle by the US. So over here on the right, we're looking at market expectations for future central bank rates, and this is just taken from financial instruments. There's a futures market and Federal Reserve rates. Investors buy and sell them, and from that you can glean where they expect rates to be. And what this is telling us is that the market is only expecting 2 rate hikes over the next year. So right now we're at this 2.25, which is currently right around 2.29 on market expectations, and that will be right around 270. If the Fed raises quarter points, which is what they usually normally do, then we should end up about 2.7 in 1 year. Well, if you look at what the FOMC, which is the Federal Open Market Committee, which is part of the Fed, what they actually say is they actually see 4 rate hikes over the next year, not 2. So the market doesn't believe what the Fed's saying, which comes as a shock to me sometimes. I know we all think we're smarter than everybody else, but sometimes you really got to keep it simple. If the Fed says it's going to raise rates 4 times over the next year unless something changes, I don't know why you would doubt them. They have a history, and we've seen this since the financial crisis. They do what they say they're going to do, and I think these rates are going to be higher. And even if the BOE, the ECB kind of join along in that rate hike, you can still see they're a lot lower. So they have a lot longer runway. I do think looking at this chart, the one thing you can all agree on across the globe, rates are going higher. They may not be going as fast as we think they're going to go. They may go faster, but I think the trajectory is up and to the right here. And we'll show you how that has an impact on bond returns going forward on traditional bond portfolios, which what we think may surprise investors a lot. So looking at it from an interest rate standpoint, we're going higher, but off a very low base compared to history. So even though if rates go higher, we still think it's conducive to a positive equity environment. It just may be more positive in other parts of the world than the US due to that longer runway they have. Now switching to inflation. So what are we looking at here? We're looking at CPI and core CPI. I'm sure you've all heard this from the pundits out there on the market. So listen to WBZ on the radio. CPI did this, inflation did this. Well, what is it? Well, really it's just a measure of a basket of goods and the changes in price year over year. And there's two ways to measure this. There's the headline CPI, which is this blue line. You can see it's a lot more volatile than the other line, and core. The difference is core just takes out food and energy because those are the most highly volatile piece of the CPI. And when the Fed looks at inflation and they look at their 2% mandate, because they do have a dual mandate, full employment and stability of prices, and when they look at stability of prices, they look at core CPI right around 2%, and they're there. And again, there's no reason why it has to be 2%. They could set a target at 3, they could set a target at 1, but looking at their models, what the Fed says and what they believe is that stability in money is at that 2%, and we can see we're right there. Another takeaway from this chart is you can see that it is going upwards and to the right, just like interest rates. So inflation is rising, which is good because we had a really bout of deflation coming out of the financial crisis. We've had this stability in prices since then, but really you can see in 2017, it looks like something changed, like inflation trying to come back. Now typically that's a good thing. That's what the Fed really wanted to do, right? They didn't want another Great Depression. They really wanted to stay away from this deflationary environment. But on the other hand, it's be careful what you wish for. They don't want this to run away. They don't want a 70s event. They don't want a 1980s event. They really don't even want a 1990s event. They don't want inflation to run away from them. So again, when they're looking at this chart and they're saying what we should be doing for interest rates, they're looking at a rising inflationary environment that could get away from them, which is another reason why, even though the market thinks they're only going to raise rates twice, I still think they stick to that 4 because they see this inflation could get away. And inflation really does hurt people once it gets too high. It eats into returns. And we'll show you on the next slide, simple math tells us that the lower the return, the more the inflation has an impact. And it's simple, right? If you're earning 8% in a portfolio and you have 2% inflation, you still get a nice 6% return, a nice real return. If those expectations of returns comes down to like 4%, which we think they are coming lower, then you add on a 2% inflation rate to that. Now we're only talking about real returns of 2%. So the markets and the Fed, they do like stability. We don't think we're going back to the 70s and 80s at all. I think that was an outlier. We had the oil embargo crisis and everything like that. I don't think we're going back there, but we do see a chance that it may run away from the Fed. And this would not be good news for stocks or bonds. So this is one of those big risks we're looking at in the market. If inflation runs away and that 4 rate hike turns into 6 rate hike or 7 rate hikes, so that's how they dampen inflation. They raise rates to bring in the liquidity, which should lower that inflation. That is one risk we're really seeing in the market. Again, it's not our base case. We don't think it's highly probable, but it'd be good for investors to have some inflation protection in their portfolios just in case this inflation number runs away. Now we're going to put interest rates and inflation together because they have such a direct impact on each other. Now what we're looking at here with this blue line is a nominal 10-year treasury yield. Again, nominal means X inflation. So that's just what the coupon says. If a federal bond pays 3%, that's a nominal yield. If it pays 16% like it did back in 1981, which still amazes me that you could actually lend the government money for 10 years and get a 16% nominal income payment. Again, inflation was a lot higher back then. It was 4%. So you didn't really earn that 15%. You earned about 10%, but still it's an amazing number. And what we've seen since 1981, interest rates have been in a perpetual state of decline. You've seen this. So what does that mean for the bond market? Interest rates go down, bond market prices go up. That's what we've experienced pretty much since 1981. A little bouts here and there of interest rates rise, but nothing to write home about. So investors have kind of conditioned, again, recency bias. What have they experienced? They've experienced that you buy a bond fund, you get positive returns. That's just the way it is. Well, history says that's not the way it has to be. It's just the way we've experienced over the past few years here where these rates have always come down. Looking at the difference between this blue line and this brown line is the inflation rate. So that's why that gap is there. And you can see the real yield, nominal yield, upwards to the right. And we still think this can go further. So again, we're not looking for runaway inflation. We just think this downward sloping nominal yield environment we've experienced over the past 30 years or so, call it, it's not going to happen going forward, that we're going to be in a different environment. And you have to prepare yourself for that the bonds may not be the best way to hedge against excess volatility in the marketplace, and that you may need a dose of inflation-protected securities and some alternatives. So this really explains why I say it's not your parents' bond market, because what you've experienced recently may not what you experience going forward. So we looked at the inflation environment where it's stable right now. We fully expect it to be in a good inflation environment for equities. We looked at interest rates, definitely rising to the right, but off a very low base. So that still conduces to positive risk returns. And now we're going to look at the third and final piece of the big three, growth. Now, growth is the most volatile and actually the hardest to nail down. And just because of the ambiguity of what it actually is, define growth. It's kind of like what the Supreme Court judge said way back when, I know it when I see it, which is all good and well, but doesn't tell us about the future. We're very good at measuring what happened with growth, like GDP measures what happened in the economy very well. Doesn't really tell us anything about what's going to happen. So we're going to take what we think in the growth aspect that actually matters to future price returns and the future growth environment and kind of look what that's telling us. So let's take a look at it from the corporate US lens first. And what we're looking at here is all kinds of earnings per share values. So the first thing we're looking at right here, again, we're going to unpack this a little bit, make it as simple as possible because there's a lot of information here, and just take the signal from the noise. This is consensus EPS going back in time, back to 2011. And all this is telling us is that before earnings happen, analysts get very happy about earnings. They raise their expectations, and then they lower them. Big difference in 2018. Again, some of this has to do with the tax break that came through, but we do think this creates an environment where earnings can still grow, given where we are. So we're seeing a very positive earnings environment. And we can see that down here. We look at the EPS growth rate. Still, 2017, 12% growth rate in annual EPS growth. 2018, we expect 19%. Going out to 2019, 7%. 2020, 5%. And again, these are expectations. These aren't real numbers, but we're looking at the environment. All the analysts from the bottom up, averaging everything up, still sees a good growth environment for US equities. Looking at it from another standpoint, in the current quarter, third quarter, still looking for a growth of 21%. So even in this current quarter, even with all this volatility, we're still expecting good growth in EPS. Now, EPS is kind of a moving target. Corporations can do buybacks. They can decrease their share count. They can manipulate some expenses to maybe grow that and get a higher multiple. But what they can't manipulate is sales. Sales are sales. You either have growth or you don't. And when we take a look at sales, which is this last chart we're going to look at here down on the right, it's still equal in 5%. So again, we saw this decrease in growth 2015, this little blip. But then 2016, a little bit better growth. 2017, we're looking at 7% growth, which is good. Estimated for 2018, 9. 2019, 5, 4. So again, unpacking this chart, taking a step back, looking at the bigger picture, it's telling us that at least from a US corporate viewpoint, we're seeing good growth expectations in the market. We expect growth to continue. Now, the US is not the world. There is a whole other piece of this world, almost half. And let's take a look at the international earnings. A little bit different chart. Again, they don't have the same insight into the data. They don't have as much disclosure as the US. And what we're looking at here is the global earnings on this side is breaking it down to US, highest growth expectations, Japan, EM, Europe. Again, taking a step back, the US is the most robust growth, but we're still seeing good growth in Japan, in the EM world, and Europe. So again, we're still seeing growth and we still expect growth to happen. Now, granted, we're not seeing robust as the US, but you're being compensated with lower valuations. So what does that mean? Look to the chart on the right here, and we're looking at historical current valuations using PE of what's going on in the market. So this is the first chart, the US, purple line, average. So historically, over the past 25 years, it has averaged a little under 16.5, 16.2 PE ratio. Right now it's at 16.9, overvalued. Moving to the developed market world, which is international, under its historical average. Europe, under its historical average. Japan way under its historical average. EM under its historical average. So that's what we mean why we don't have to see as robust growth in different parts of the world. They have, given their valuation levels, they're not priced to perfection like the US is. So international EM can have a few missteps and still not far as further because they're not priced to perfection. They have that valuation support underneath. So again, expectations matter. Buying growth just for growth's sake does not always work, especially when you're in your high valuation marketplace. So we do think international EM still offers some good value for investors out there. So that unpacks the corporate world, good growth across the globe. Let's look at the economy. So what is the data telling us about the economy and trying to find the signal through the noise? So what we're looking at here is manufacturing momentum. And again, just looking at this chart simply, knowing what we've all known, green is good, red is bad. You look at this last piece in 2018 in this last reading, you see green across the board. So even without any insight into the markets or the economy or what this is telling us, you can see that we're in a positive manufacturing environment across the globe. So we're seeing robust growth across the globe. And we're seeing positive data in the forward-looking economic environment. And what does that mean? That's one reason why we use this. We use the PMI in our model, and we're looking at it here, is that it just doesn't tell us what happened. It tells us a lot about what we expect going forward. So what the PMI is, it's a diffusion index. So not getting into the big details about how it's calculated by third-party source, but what they do is they call purchasing managers across the globe, across the world, people who are in the right position to know what's going to happen in the future, and ask them a series of questions. And what their choices are is the environment you're working in getting worse, staying the same, getting better? Are you planning on hiring less people, the same people, more people, et cetera, et cetera? Add up all that numbers, and when that number is above 50, we're in expansion, not just through history or through the historical lens, but also what they expect going forward. So when we're looking at the global economy and companies who are on the front lines of ordering, and you're not going to order a lot of goods if you don't see growth coming, they're still expecting very robust growth. And it's across the globe. It's not centered in the US. We're seeing robust growth. I mean, the only two countries that are even below it are Korea and Russia, and they're just below it. So again, US, international, EM, corporates, seeing growth and expect growth in the future going forward. The people who actually do the ordering, who run the companies, who look at the global economy, they're seeing growth. They're seeing future growth. So again, looking at those two pieces of the market, it's tough to find how we're going to get a recession. So let's turn to global trade. Again, this is the big one I hear about a lot now. We have the global trade wars. We're going to have a trade war. We're going to unpack that a little bit, talk about the economic backdrop. And the first takeaway from this chart is what we're looking at is world trade volume, year-over-year change, 3 months smooth to smooth out the volatility, is that we're still seeing very good growth. As of September 2018, trade is still growing about 4%. Granted, the average going back to 1994 is 5%. So we're running a little bit below average, but we're still seeing very positive growth. We're not in these negative growth areas that we saw in 00 and 08. We're still seeing good, robust growth around the world. So the takeaway is that even though you hear all this rhetoric on the news about trade slowing and tariffs and trade wars, as of right now, that's not coming through in the numbers. Trade is still happening, and it's still growing. And this is one thing we'll be really watching out for to see if this really starts going down lower. But as of right now, we don't see this trade stopping. The other way to look at this is, that's great, it's happened, but given all the rhetoric we're seeing, what if this trade war does really happen? And it's not in our base case. We don't think it's going to happen. We do think the grown-ups in the room will stand up eventually and come to a deal. But it's a helpful exercise to kind of look at the environment that's in. We look at this from the US-centric, as we're US citizens, most of us listening to this, and that's what we usually look at. We look at the US and exports. So just looking at exports, what we sell to the rest of the world is about 8% of our GDP, so 8% of our economy. So most of our economy is internal, based in the US. Looking out the world, it's found that even other countries, even China, only 20% of its GDP is trade, exports. Mexico, 36%. Korea, 37%. China we looked at India, 11%. And the big takeaway from is look at the composite of that growth. We're looking at this right here. This is the US. So if you look at this percent of the US, but look at China, total exports to the US average is only about 10 to 11%. They trade much more with the EU, EM ex-China, so all the other Asian countries. Same thing in India, Brazil, Russia. Yes, Mexico trades a lot with the US. They're right next door. You can look at Canada too. They both trade a lot, so they get highly focused. But when we start talking about the trade wars, we start thinking about this. Take a step back, and what if the US just shut itself out of the trade market? You know, all the rhetoric increased. We're going to have a trade war. We're not going to buy your goods. We're not going to sell your goods. We're not the only game in town. We may be the biggest, but we're not the only game in town. And there are other options for these countries. So there is a scenario, however unlikely, that if the trade war increases, we see a lot of noise on that front, that the rest of the world just turns away and says, you know what, US, we're just going to trade with ourselves. And the US is leading this trade war charge. They're not the only one. There are a bunch of other ones out there, but the US is taking the lead on this, and that they could trade with themselves. So even if there is a trade war, a slowdown in the US, it may not cause a big drop in world trade. There still may be trade going on. And again, very low probability of a trade war. We don't think it's in the cards, but again, looking at all options, trying to find the signal to the noise, that it may not be the death toll for the global economy. That other countries can trade with each other, still grow, and given that valuation support they have, they may not fall as far as the US does. So that's kind of taking a look at the current environment to the big three. And what we take away is that interest rates look like they're going higher. We fully expect them to go higher off a very low base. The international EM are far behind the US, so they may be lower for longer and have increased liquidity, which should help their risk assets. International EM are in a much better valuation picture. The US is a little expensive. Inflation is subdued right now, right where the Fed wants it, at that 2%, not getting away, but there is a chance, but we don't think it's a high probability. So inflation is conducive to growth right now. We look at the corporates in the US and international, they're still showing growth. Economies are still growing. Global trade is still showing growth, even though it's a little bit below average. So given all those, it's really tough to find a recession around the corner anytime soon. Now again, the caveat is, this is data as of 9:30, and we're getting constantly updated with new data points, and we follow them religiously. And we'll be the first ones to see if the data changes and find that signal to the noise and change the portfolios. But all the data we're seeing, all that we think matters to future growth, we're still seeing an environment conducive to growth, no matter what the price action in the equity markets is saying. Doesn't mean it doesn't have an impact on investor sentiment, but in terms of economic growth, we're still seeing very strong growth across the globe. And why do we focus on that all the time? And again, I get a lot of comments and questions on, you know, you keep focus on this economic growth, on not having a recession. Look at what the price is telling you. Well, I thought this chart would come out and help us why we focus so much on that. We do look at the world through multiple lenses. We look at it through technical, valuation, economic, which is a big piece of it, and qualitative. And it helps kind of what is our risk model trying to help us identify. It really is trying to help us identify the potential for a big sell-off in the market, or what we call a bear market. Bear market is defined as a drop of 20% from its peak. Again, no magic reason why it's 20%. It could be 25, it could be 30, it could be 15. Someone somewhere just kind of decided that 20 was the magic number. It kind of stuck in everybody's brains, and that's what we use. So the chart from JP Morgan going back to 1926 looks at those drops of 20% or more of what we consider bear markets, and there have been 10 of them, going back to the crash of 1929 all the way up to the recent global financial crisis. And what they've done is they've kind of unpacked them a little bit. So we look at the bear returns, the market from peak to trough, and you see some pretty scary numbers there, 86% back in 1929, almost 60% during the financial crisis. But that doesn't tell the whole story. It's also duration. So we look at duration. The crash of 1929 took 32 months until you came back. The global financial crisis took 17. But there are some that had really poor price action, like in 1987 crash, the program trading, dropped 34%, but you recovered in 3 months. The flash crash in 1962, you were down 28%, pretty scary, but the duration was only 6 months. And then we take a look at the characteristics of each of these environments as we look through here. So these 10 bear markets, and the first thing very clearly jumps out of the page, the big ones, the ones that were depth, and duration were all accompanied by a recession. So this is why we're really trying to look at, growth, inflation, interest rates, what it means for growth, because we don't want to be in a poor performing market when there's a recession. That's when you get those big bear market returns, those markets that do lasting damage to your portfolios, or what we call hurricanes. That's the difference between a hurricane and a thunderstorm, is these recessions. Again, history does not always repeat itself, but it does rhyme, so it's not an exact science. You can't say that it has to have a recession. I'm sure there's some time that it will fall in the future that it's not accompanied by a recession. But when looking through all the data, you really want to try to avoid have a high risk portfolio when a recession is in the cards. And again, looking at all the data, a hint to what we're going to show with our model, we don't see that happening. So again, what are we trying to prevent in your portfolio? Well, we'd like to prevent every decline of any magnitude in your portfolio, but we all know that's impossible. The only instrument I ever saw do that was run by someone called Bernie Madoff, and we all know how that turned out. So again, volatility is normal, it's to be experienced, but we want to control the depth and duration of it. The most hurtful ones include a recession, and that is why we're really looking for that in our model, and we use that as a big piece of our model. Bull markets don't die of old age, but through external shocks, which trigger recessions, and that is what we're trying to identify with our risk model. So with that, let's take a look at what our risk model is telling us about what's most likely to happen in the future. So what we're looking at here is our risk model. Now, there's a lot of indicators under this. Each one has about 4 or 5 together. So we have about 20-something indicators that we look at, but we've kind of collapsed it. So we just kind of look at the big picture, the big 5. So the first one is technical structure. What is the structure? Well, what we're looking for here is that historically, bull markets are led by strong investor sentiment as investors increase their risk tolerance. So what we're looking for here in the structure is things like stocks above the 200% day average. Are a lot of stocks moving in the right direction? Are investors buying the right part of the market? Are they buying the riskier parts of the market? Putting that all together, you can see that we exited the second quarter at a +1, and we pretty much stayed the same. We had a big bump up in 831, but 930 came down to what? To +1, still positive. So when we look at investor sentiment, we look at investors' risk tolerance. Are they buying the right parts of the market? Are the right parts of the market performing? Are enough stocks performing above the 200-day moving average to provide support for a sustained bull market? The answer with this model as of 9:30, not taking into account what's happened recently, the answer is yes. So we're in a strong, positive technical structure in the marketplace. The other piece of technical we use is reversion. And very simple, we have a philosophy and a belief here. Markets oscillate around the mean. What does that mean? Markets go up and down. And what this reversion indicator is trying to do is trying to identify those inflection points. So characteristics of what causes a market to turn: overvaluation, overbought and oversold conditions, break points in terms of moving averages. So what historically has led to a change in the market performance. And again, as of 9:30, we haven't seen much change. We exited the second quarter at a +1, and as of 9/30/2018, still at a +1. So what are we looking at from a technical picture? Positive. Not hugely positive. The biggest positive number we could get here would be 8, but we're still positive, still leaning positive. So from a technical standpoint, positive. Valuation, no surprise if you heard me talk at all at any time. We're in a very poor valuation picture, have been for a while. The caveat to that is valuation is a poor timing tool. Markets can stay overvalued for a long time. But historically, we do know that long-term bull markets begin when markets are cheap and they end when they're inexpensive. So unpacking that, what does that mean? It means that a bear market is more likely to happen, not positively going to happen, not 100% going to happen. There's just an increased chance of a bear market happening when the valuations are high. And currently valuations are high. We exited second quarter 2018 at a -2, and we're at a -4 right now. We double weight valuation because we think it's such a big driver of long-term returns. But again, -4 is not the most negative it could be. The most negative is a -6, but it's still pointing to negative. The one positive piece of valuation we're seeing is those earnings, as they're really kind of coming in stronger than expected, and it's giving a little bit support to our valuation indicator. So negative valuation. Economic, as we saw in terms of the PMI indices, we also look at jobs, jobs being created. We look at new orders from companies, are they increasing their orders? All that points to signs of future growth if it's positive. It points to signs of a possible recession if they're negative. And we're looking across the board, we're seeing very strong, robust economic numbers. Comes in at a +3. Qualitative, that's a judgment of myself, Jamie Upson, David Giuliano. Each have been in these markets for about 20 years. We've seen a lot of bull markets. We've seen some bear markets, at least in the short term. But again, using our judgment for the environment. And when we look at the interest rate environment, it is still very low. They are going higher, but still very low. Inflation being subdued or at that 2% level. We still think it's conducive to a positive qualitative picture of the marketplaces. Not hugely positive, just slightly positive. Adding that all together, you end up with the current risk environment of a +2. So as of September 30th, 2018, looking at the market from a technical valuation, macroeconomic, qualitative, multiple lenses, looking at the big picture and the weight of the evidence, it leads to a conclusion that we're not likely to see a recession anytime soon. That means any given price volatility is more shorter term in nature and not of that big depth and long duration that cause lasting impact, negative impact to client portfolios. So we're still taking normal risk in client portfolios. That being said, we do see the environment getting a little bit more cloudy given the recent price action. So I'm going to kind of move forward here a little bit and take into account our portfolio position as of October 26th. So again, this is X930, this is October 26th, just last week. And we did make a trade in the portfolio given this cloudiness we're seeing in terms of the price performance in the marketplace. And what we did is we reduced risk. What does that mean? Just reduce the average volatility in our portfolios a little bit. Given the poor sentiment we're seeing a little bit in the recent price action, the fastness, how quickly these things are declining, we just thought things are getting a little bit more cloudy. We don't see a recession. The data's not pointing to it. We don't see this big negative picture here. We do think we bounce back, but we'll let the data kind of drive that and tell us where that's happening. But at least for now, we thought reducing risk is a very prudent way to do in your portfolios. So how do we do that? Well, on equities, we're still neutral compared to last quarter. We still aren't neutral. We think where you take risk matters a lot more in the equity markets. We're underweight the US. We were last quarter. We are this quarter. We did not touch our US equity exposure. International developed is where we made the change. We were overweight internationally developed in second quarter of 2018, and we moved that down to a neutral. We did that by a small trade, moving 5% from international developed markets into the fixed income market, which moved that from an underweight to a neutral weight. And it's good to know that a neutral weight is relative to a benchmark. So it's relative to the traditional 60-40 benchmark that everybody uses to measure themselves. And it's a good way to measure where we're taking risk in your client portfolios. And what we're looking at is that given the recent price performance, taking a little bit off the table, putting some into fixed income is a very prudent thing to do. The neutral is ±4% to the bench. So it's not being equal to bench. We have a little bit of a bandwidth there because again, due to the price action, clients moving money in and out of portfolios, there's always a little bit of drift in prices. So we use that ±4%. Still very overweight emerging markets. Do like emerging markets. We saw the valuation picture. They're getting hit along with the US and international developed in this recent volatility storm. But again, given the valuation picture, given the growth prospects, we still think that even though you have to experience a little bit more volatility, and we'll show you that expected volatility on the next slide, that it still offers a very good risk return trade-off if you look out over the next 10 years. In other words, that we're being compensated by expected returns over the next 10 years for living with some of this increased volatility. Cash, we're neutral on. Commodities, we still don't like, still underweight. Again, I do think people can trade commodities. That's not me. That's not what we do. Short-term traders can go move in and out and probably have a good trading program to trade commodities. We use managed futures for that. They're the ones going long and short commodities in our managed futures product. So we'll let the professionals and the real experts at that stick with that. We're going to stay underweight commodities. And again, overweight alternatives because when we look at the expected return profile of all these asset classes, we really think what we've experienced, again, since the 80s, is about to change. We saw the fixed income market's going to change. The US equity market has become more volatile than we've seen recently. And we just think that dampens the return profile, not to negative, but dampens it enough where investors would be better off served if we look out over the next 10 years to have some exposure to alternatives. And what is an alternative investment? There's many definitions. Everybody has their own. I think a lot of them are false out there, and you have a lot of salesmen out there. The way we look at it at Stonehearth Capital, alternative, it's any investment whose price action is not dependent on the US, international, EM, or fixed income markets to generate return. Doesn't mean they're always going to go opposite those markets. Doesn't mean it's always positive. Doesn't mean it's always negative. All it means, it generates a price return stream that's not dependent on the US equity market, international, EM, fixed income going up. It can generate positive returns in down markets. And to say can, doesn't always happen, but it can. It's not dependent. And we think it's a good spot for investors to be. So that's kind of how we stand from a portfolio standpoint. And I thought it'd be good today to kind of look at expected returns. Kind of give you, a little bit of a backdrop of what we're looking at and why we say that although we don't like volatility, sometimes we're compensated for taking it on. And what we're going to look at is asset class expected returns. And what we're looking at here is a third-party website, Research Affiliates. They're one of the providers we use, not the only one. We have information from Ned Davis, we use GMO, we use our own internal calculations to kind of look at this. But again, this gives us a good understanding and a simple way to kind of look at it. And once we do all our numbers, take into all our variables, we end up pretty close to where they are. So what are we looking at here? So on the left hand right here, real expected returns. So again, we talked about real and nominal. Real, when you see that, means X inflation. So if we look at EM equity here, expected to return 7%, that's after inflation. So on nominal returns, it probably returns 9%, but then take 2% away from inflation, makes 7%. And that's expected annualized returns over 10 years. So it doesn't mean over the next 10 years, you're going to earn 7%. It means that if you invest in emerging markets right now, closed your eyes, went to bed, woke up 10 years from now, more than likely you'll have an annualized return of about 7% in your portfolio. But with that, you will experience volatility along the way. And that's what this chart shows you down here. How much volatility do you have to handle in your portfolio to get that 7% return? And you do. You have to handle a lot of volatility, but you're being compensated for it 10 years out. And that's not always the case. And we look at US large, it's kind of a good trade-off. So remember, EM equity, 7%, 22% fall. So the US, definitely expected to be less volatile, only 14%, but for that 14% volatility, you only expected to earn 0 returns, 0.1%. So there's your range of returns. Not very conducive to what we've seen in the past. We look at US small, not expected to be a lot of returns. Global treasuries, REITs, nothing is looking hugely attractive when we look out from 10 years and where we're expected to be. And all we wanted to do here is try to find the asset classes, when we put them all together, gives you the expected volatility that you are most comfortable with. And that's why we have 3 different portfolios, conservative, moderate, aggressive, where we rely on that volatility line to generate these expected returns. And given that how low we see these expected returns are, not negative, but low, we think alternatives really help improve that case. Now, we don't have alternatives out here as an asset class because it's such wide ranging in how you do it. There is really no way. But when we look at alternatives, what we expect is, since it's not relying on the markets to generate returns, that we're looking for low single-digit returns with less volatility than other asset classes. So we're looking for something right in this range. And we think, given when we look at everything out here that we can invest in, 4 to 5% return with like a little bit of volatility here is looking very attractive given the other choices we have. The other things too we hear a lot is, so US small, expected 0 return. Why would you invest in this at all? Well, again, these are targets. These are 10 years out, subject to change. And again, we're just trying to get close. This could be 5%, maybe negative 5%. So again, it's that weight of the evidence, weighing everything, and taking what the expected returns are and the range of outcomes and building the best portfolio. So we do still have exposure to US small. We have exposure to US large. We don't see that changing because, again, given the range of outcomes, you're being compensated for a little bit for that return, but not a lot. You're being more compensated in emerging markets, which is why we have a higher weight and why we're overweight emerging markets compared to the benchmark. So kind of taking a step back and looking at this big picture, again, we look at it from our risk model, Technicals still look pretty strong. We'll see how they end up this month. They're going to be a little bit weaker, and if that data has a signal for the noise, we'll make changes. A positive economic environment. We do think the global trade war will impact volatility but not have long-lasting impacts on market returns. We do expect a lower return environment for traditional asset classes than we've seen in the past. Some of that can be explained by the valuation picture, the heightened valuations we see in the US, the interest rate environment. Again, we saw that long shot coming down from the 80s. That's providing liquidity in the market that helps risk assets returns. Inflation's higher, helps risk assets. We don't see that going forward, that there's a big change in the marketplace. So you don't want as much exposure as you previously had to some of these asset classes. And looking out 10 years, we're willing to take some increased volatility to get this excess return for your portfolios. So that's kind of where we stand from a portfolio place. We think this short-term volatility we're experiencing right now doesn't turn into anything big. It could change. We're seeing some positive price action today. And what we're really looking for is follow through. So we'll let our model decide. Do we see the technical picture weaken into negative territory? Does the rise in the markets go into a smaller and smaller number of securities? Do investors take risk off the table and they're really decreasing the sentiment in terms of the marketplace? Does the valuation picture get worse? And what the real key is, does that economic environment change due to the recent price action? So there's a cause and effect. And I fully admit that there could be a cause and effect. As you look at the screens and you see negative price action, that turns into emotion and people act behavioral and they change their economic growth expectations and rein that in, and it could lead to recession. That's one possible outcome. We don't see that happening now in the data, but we'll kind of have to wait for all the data to come through and see. So right now, we're still taking normal risk. We do think the picture got a little bit more cloudy given the recent volatility. We took some volatility out of clients' portfolios, but for now, still taking normal risk. So with that, I'd like to thank you all for attending. I think now I'm going to turn it over to Amanda so she can go through, see if there's any questions. Let me pull up question and answer slide with our required disclosures, so please read that so the lawyers don't get all over me. And with that, Amanda, do we have any questions?
Hi, Chris. Thanks so much for all that information. We do have a couple, but just as a quick reminder, if you want to use the questions tab there on your GoToMeeting taskbar, you can certainly submit those questions and we'll try and get to those for whatever time allows. So Chris, the first question is, why is momentum only listed in the 3-month chart and not the 1 year?
Oh, someone's paying attention. Good question. Let me go back here. Let's see. So basically the question is, if we look at the third quarter performance, we have momentum, the best performer, and it's not here. So what we actually do when we look at this is we take the top 18 major asset classes that we follow. So again, if I put every single asset class out here, you'd have a chart that you couldn't even read. So we kind of narrow it down to the most important top 18 asset classes, which does not include the momentum factor. But what we also do is to make sure we include everything and get the right information out there is that we take the best performing asset class and the worst performing asset class during the time period we mentioned and add it back to the chart. So it just so happens in the third quarter of 2018, momentum was the best performing asset class. When we look at it on a 1 year performance, it wasn't, so it dropped off. So again, you always see the S&P 500 out here, you always see mid-cap, you always see the dollar, but you'll see asset classes come and go as they reach the top performer or the bottom performer, which is why momentum made it to the third quarter and not the 1 year performance.
Chris, the next question we have is, given the recent sell-off, why haven't you reduced risk further?
Good question. Again, we're seeing a little bit of change in the marketplace. We did reduce risk a little bit, took it off. But again, we're not seeing any follow through yet. So the price performance is what it is. We're seeing increased volatility. We're still seeing a positive technical environment. Still seeing the same valuation picture, not getting worse. Actually, with the price declines here, it's improving a little bit. And I think it's really that economic environment. We're really still seeing, on the numbers that matter, strong economic growth out there. And I think the kind of way I look at it is, what would have to happen for me to reduce risk further? And to me, it's really that environment has to weaken. We saw it get a little bit cloudy. We don't see negative growth. If the risk of a recession really increased, and we saw that in the data, then we'll be reducing risk further. But given everything we're seeing in the marketplace, given everything we're seeing in the indicators, even given the recent price performance, it seems more like one of those thunderstorms and not a hurricane yet. But again, we'll let the data tell us that, and we may change as we get more data. But right now, the reason is that we just really haven't seen a totally weakening of the economic picture yet. Hopefully, we don't see that, and when we rebound from here. But we're prepared to do what is necessary when we see the data change.
Chris, just for timing purposes, we'll just go with this one more question. What caused the recent sell-off?
Wish I knew. It's interesting. I used to work on a trade desk at Putnam, and I run a portfolio. We kind of go up and say, why did this name move up or down a given percent today? And the traders always look at me and say, more sellers than buyers. And I always thought they were kind of like talking down to me or anything like that. But given my 20 years in the industry, having a long time to learn what they were actually talking about, it really is a big kernel of truth into that. There really was just more sellers than buyers. And then we can kind of look back and say, okay, what caused something to change? Where did these sellers come from? And we can play the blame game. I think the big ones out there you hear all the time are the Fed raising rates. Problem with that one I have is that, well, they've been raising rates for a while here. They've telegraphed that they're going to raise rates. They haven't done anything they haven't said they were going to do. So there really was no change. Talk about the trade war. Well, the trade war has been out there for a while. The tariffs that we announced are out there. Everybody knows what they are. Nothing's changed. We haven't made any new tariffs. The rhetoric really hasn't increased tremendously. So looking at what caused it, in September, the trade war was similar to what it was in October. So I have a tough time thinking about the trade war. Overvaluation is always kind of labeled as a boogeyman out there, that they're overvalued, they have to sell off. Well, EM and International are considered cheap across the board, not just by us, by most valuation metrics, and they fell just as much. So I don't think it was the overvaluation picture. So again, it's kind of an opinion and what happens. If you look at the market, it consists of thousands of individual constituents, people, and computers nowadays making decisions. So it's really impossible to tell what drives any price movement on a given day-to-day basis. But again, given in the industry, looking around, there really was just more sellers than buyers. And I do think a lot of it has to do with the new structure in the market we've been talking about. ETFs do make it easier to trade. I think they're a great invention. If they're used correctly, I do think they speed up trading and speed up volatility events in the marketplace that hurts. We do have a lot of hedge funds out there and liquid alts that are positioned that they have to be forced traders or price insensitive. What does that mean? They use a lot of risk numbers in terms of how they build the portfolio. So not looking at whether a stock is good or bad. They just kind of look at their overall portfolio. And every day at 2 o'clock, they kind of run their risk numbers and say we have to either increase risk or reduce risk. And what's happened is they're getting a lot of decreased risk orders from their risk people. They don't care what they sell it at. They don't care if they sell it down 3%, 4%, 5%. They have to reduce risk. So that's when they're price insensitive. Because any rational person looking at the market down 2%, if you don't have to sell, why would you sell? And you're kind of seeing this 2 o'clock sell-off happening every day. So I do think they're driving a lot of that action. And given what's happening in the marketplace with the structure, there's just not a lot of liquidity in the marketplace. So moves get exaggerated. Now, this also works to the upside, because we've seen this so far too on the upside, where a buyer comes in at 2 o'clock and really moves the market just because there isn't a lot of people on the sell side. So it's a long, convoluted answer to your question. I apologize that. But again, the big answer is there's more sellers than buyers. Sentiment has changed a little bit in the short term. And what we're really looking for is, does that sentiment change cause knock-on or follow-on effects to the other part of the economy? And we're just really not seeing that yet.
Chris, thank you so much for joining us today. Also, just a quick reminder, our next upcoming webinar is Thursday, November 29th at 3 p.m. It is Essential Strategies for a Successful Retirement, and that will be with our President and CEO, Jamie Upson. So please feel free to go ahead to our website at www.stonehearthcapital.com to register for that event, and we hope to see you all and talk to you all soon. Again, Chris, thank you so much, and we hope you all have a great day.
Thank you, everyone.
All right, take care.